Welcome to NASDAQ Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at NASDAQ. Joining me at the market site in Times Square, we have George Milling-Stanley. He's the Chief Gold Strategist at State Street Global Advisors. We're going to take a look at gold ETF demand. Of course, everyone knows the GLD. George, it's great to have you with us. And big anniversary coming up on the GLD. Very exciting.
Absolutely. 15th anniversary in November.
All right. Let's talk about the current price drivers of gold right now.
I think that Jerome Powell should get a lot of the credit because he'd promised that markets would get a cut in interest rates. He said this in June when the FOMC didn't act on rates, but he did then cut rates in July. So that was obviously very important. I think lower rates reduce the opportunity cost of holding gold, right? But there were a lot of other things that are happening as well. So irrespective of what the Fed does with interest rates in the near future, I think gold still has some serious upward momentum behind it. There are various things, developments going on in the supply-demand balance, especially in the emerging markets, strong investment buying, strong central bank buying throughout the emerging world. And if you look at the rest of the world, we're probably in an unprecedented state of concern, if not anxiety, both macroeconomically and geopolitically. When you think of all that's wrong with the world right now, then gold is a really good place for a lot of people to be.
Demand for investors, they're looking to make a play in gold for sure.
Yeah, I think it's not so much a play in the sense of a tactical play, although those opportunities are clearly there with the price having gone up $200 in just a couple of months. But I think much more important, people are now feeling comfortable making long-term strategic allocations to gold when returns on equities have got to be rather doubtful in the near future. Equities have gone up for 10 straight years. Nobody believes they'll do that for the next 10. And if you look at the bond market, what do you see? Negative yields everywhere you look. So gold is looking a lot more attractive relative to the competition.
All right, and it's certain you can see the demand is there. GLDM, it's a lower share price than GLD, came to market only 15 months ago, surpassed $1 billion in assets under management.
Yeah,
so clearly the demand is there.
Up almost $500 million year to date. I think that's very important for a young ETF like that to be able to do that. And then if you look at the 800-pound gorilla, which is GLD, celebrating its 15th anniversary soon, that's now a $45 billion ETF, $45 billion worth of shares outstanding, $45 billion worth of gold in the vault, no cash, no derivatives, so no tracking error. That's up almost $7 billion year to date. The fact that the two are growing means that we got it right, that there is a market for both kinds, the no-frills kind like GLDM or the very high liquidity vehicle like GLD.
Now, how much should investors be allocating towards gold investments within their portfolios?
There's no easy answer to that. The literature suggests somewhere between 2 and 10% is appropriate, depending on a particular investor's risk tolerance, liquidity needs, income needs, whatever it may be. A lot of people are comfortable with 5. Increasingly, in the last few months, I've been meeting financial advisors who have between 5 and 10% across all of their portfolios, not just aggressive portfolios, but across all of their portfolios. That, to me, is a very interesting sign, and I think that's very supportive of where the price is today.
To wrap up, why would you pick GLD or GLDM over other gold investment products?
Simply because they're better. There's no question in my mind that the SPDR name behind them, in partnership with the World Gold Council, who really know their stuff when it comes to gold, that partnership has been really successful. That's why GLD is easily the biggest and most liquid gold ETF out there, and why GLDM is also a very liquid vehicle and is easily the leader among the lower cost, lower expense ratio ETFs. They're just the best products you can buy.
All right, George, thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.